Long-term investing with dollar cost averaging beats everything. If you invest $10,000 in the S&P 500 on January 1st, 2004, and leave it completely untouched for 20 years, by the end of 2023, that account will be worth over $60,000. The same $10,000 managed by someone who kept jumping in and out of the market, trying to protect themselves from bad days, ended up with less than $20,000. Same market, same 20 years. The only difference was the decision to stay. This video is about 4 different ways people try to build wealth in the stock market. Only one of them works for everyday people. The other 3 destroy more money than market crashes ever have. And the financial industry, in some cases, has a vested interest in making sure you never figure out which is which. What is day trading? Day trading is exactly what it sounds like. You buy a financial instrument like a stock, an ETF, or a futures contract, and you sell it the same day, sometimes within minutes. The goal is to profit from short-term price movements, not from the underlying value of the business. Day traders rely on charts, technical patterns, momentum signals, and news flow to make dozens or hundreds of trades per session. Listen to them talk and it sounds like skill, but the data tells a different story. According to FINRA, the Financial Industry Regulatory Authority, 72% of day traders ended the year with financial losses. 80% of day traders quit within the first 2 years. 40% quit within the first month alone. It gets worse when you factor in taxes. In the United States, profits from positions held less than 1 year are taxed as ordinary income, rates between 10 and 37%. Compare that to long-term capital gains rates of 0 to 20%. A trader in the 24% tax bracket who earns $50,000 in capital gains pays $12,000 in taxes. The same return held longer costs only $7,500. That is a $4,500 difference that comes directly out of their pocket. There's a structural reason for this failure rate. Day traders aren't just competing with each other, they're up against institutions running high-frequency algorithms, market makers, and proprietary trading desks with data, technology, and capital that retail participants don't have access to. It's not a level playing field, and it was never designed to be. Warren Buffett has been blunt on this. At Berkshire Hathaway's 1994 annual meeting, he said, "I never have an opinion about the market because it wouldn't be any good, and it might interfere with the opinions we have that are good." His point was that spending the energy on short-term market predictions is not just unproductive, it actively competes with long-term thinking. What is swing trading? Swing trading operates on a slightly longer time frame than day trading. Instead of closing positions within a single session, swing traders hold stocks or other instruments for anywhere from a few days to a few weeks. The strategy still relies on technical analysis, chart patterns, moving averages, relative strength, and the goal is still to capture a short-term price move, not to participate in the long-term growth of a business. The underlying problem isn't intelligence, it's timing. Markets are not predictable in the short run, and the attempt to profit from short-term predictions consistently costs more than it returns. Peter Lynch ran the Fidelity Magellan Fund from 1977 to 1990 and delivered average annual returns of 29%. His observation on the subject was direct. Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in the corrections themselves. What is timing the market? Market timing is the attempt to move money into the stock market before it rises and out before it falls. It's a broader strategy than day trading or swing trading. A market timer might be out of stocks for weeks or even months, waiting for the right moment to get back in. It sounds rational and prudent risk management. The data shows it's one of the most reliably destructive strategies an investor can pursue. The mechanism that makes it so damaging is concentration. Market gains don't accumulate evenly across trading days. They cluster in ways that are nearly impossible to predict. Research by Hartford funds using S&P 500 data found that 26% of the market's best days over any given period occurred during a bear market or within the first 2 months of a bull market, not during the calm, confidence-building stretches when a market timer would feel comfortable re-entering, during the exact periods of maximum fear. Wells Fargo Investment Institute analyzed 30 years of S&P 500 returns from July 1995 through June 2025. During that full period, the index delivered an average annual return of 8.4%. An investor who missed the 30 best trading days, spread across 30 years, saw that return collapse to 2.1%, below the average inflation rate of 2.5% over the same period. Missing the best 40 days took the return to 0.7%. Missing the best 50 days produced a negative annual return. J.P. Morgan Asset Management's analysis makes this concrete. $10,000 invested in the S&P 500 on January 1, 2004, fully invested for 20 years through December 2023, grew to just over $60,000, an annualized return of 1.5%. Missed the 10 best days over those 20 years, under $35,000, a return of 6.2%. Missed the 20 best days, $26,000. Missed the 30 best, $21,000. Missed just 30 trading days out of more than 5,000, and 2/3 of the portfolio's growth is gone. The cruelest part of this data is the timing of those best days. J.P. Morgan found that 7 of the 10 best days over the last 20 years occurred while the market was in a bear market. 6 of the 10 best days occurred within 2 weeks of the 10 worst days. In 2020, the second best day of the year fell right after the second worst day. In 2015, the best day came 2 days after the worst. A market timer who sells during a crash to protect their capital does so right before the market's most explosive recovery sessions. They are structurally positioned to miss the exact days that matter most. The phrase that captures this reality has been repeated by the investment world's most credible voices for decades. Investment analyst Ken Fisher put it precisely in a 2018 article for USA Today. Time in the market beats timing the market, almost always. What is dollar cost averaging, and why it works? Dollar cost averaging is the practice of investing a fixed dollar amount at regular monthly or bi-weekly intervals, with each paycheck regardless of what the market is doing. You don't wait for a dip, you invest the same amount on schedule and let price fluctuations work in your favor automatically. The mechanics are straightforward. When prices are high, your fixed dollar amount buys fewer shares. When prices are low, it buys more. Over time, your average cost per share trends below the average price of the asset. That means you're acquiring more shares during downturns than during peaks. You don't have to predict anything. The strategy does the work. For most working Americans, this isn't an exotic strategy. It's exactly what a 401k does. A portion of every paycheck goes into the market on a set schedule, every pay period, across every market condition. Most people doing this have been dollar cost averaging their entire working lives without calling it that. The deeper value of dollar cost averaging is behavioral. It removes the decision. The investor who contributes automatically every month, regardless of headlines, never has to answer the question, "Is now a good time?" That's because the question was already answered before the market opened. This matters because investor behavior is where most wealth destruction actually happens. The combination of consistent dollar cost averaging and extended time in the market is the same force that turned Buffett's career into one of the most documented compounding stories in financial history. He has held Coca-Cola since 1998, his favorite holding period, in his own words from a 1998 letter to Berkshire shareholders, forever. And time in the market beats timing the market. If there is one piece of data that captures the cost of market timing better than any other, it's the J.P. Morgan Best Days chart. The chart tracks a $10,000 investment in the S&P 500 from January 2004 through December 2023. A fully invested portfolio grew to $60,750 over 20 years. The same portfolio, missing only the 10 best trading days across 20 years. 10 days out of roughly 5,000 fell to $29,708. That's less than half. 20 days missed, $20,531. 30 days, $15,100. 40 days, $11,231. 60 days, $6,000 and change. Actually less than the original investment. 60 days and 20 years, and the money is gone. Bank of America conducted a similar analysis going back to 1930. If an investor missed the S&P 500's 10 best days in each decade, total returns came to 91% over the full period. Investors who stayed put earned 14,962%. Think about that for a minute. 91% versus 14,962%. Same market and time frame. The only difference was humans getting in the way. What the greatest investors have actually said. Warren Buffett has described the stock market as a device for transferring money from the impatient to the patient. He bought his first stock in 1942 at 11 years old during World War II. He has watched atomic weapons programs, multiple wars, multiple recessions, the 1973 oil shock, Black Monday in 1987, the dot-com collapse, the 2008 financial crisis, and a global pandemic. Every one of those events looked in the moment like a reason to get out, but he never did. In a reflection after missing the March 2020 market bottom during COVID-19, he acknowledged openly that even he could not time the market. If I had any sense of timing, I would have bought stocks in March 2020. He didn't. He stayed his course and continued compounding. The S&P 500 was up over 100% within 2 years of that bottom. The investor who opened a brokerage account in 2004 set up an automatic monthly contribution and never touched it through the 2008 crash, through 2020's pandemic plunge, through every election, every rate hike, every headline. That investor turned $10,000 into $60,000. The decision that produced that result was not brilliance, skill, or timing. Discipline compounded across decades is the only edge that actually survives in the market. Time in the market beats timing the market. It always has. If this video helped you think differently about money itself, please hit like, subscribe, and turn on the notifications tab. I'm a former stock and bond broker with over 15 years of experience. I worked for 2 top-tier investment banks on the West Coast before I retired, and I spent my career inside the very financial system we've been discussing today. What this channel is about is to give you the kind of insight and background on capital markets that most people never get access to. The stuff you learn from working on the inside. Because here's what I learned after 15 years on the desk. Finance is not as complicated or as intimidating as Wall Street wants you to believe. And the more you understand how this system actually works, the better decisions you'll make with your own money.